Good evening, dear applicants. I am very glad to see you today at our meeting, at our meetup. And today we will speak about a very important topic, how ESG affects the construction of the investment portfolio. This very hard job will be done by our Professor Elena Dimova. But before providing her the floor, I would like to remind you the terms of our meetups. Please keep in mind that those who would like to apply for the program Finance or Financial Analyst could participate in meetups. That's what we are doing right now. As a result of visiting meetup, you should submit an essay with graded. Afterwards, it will be a final assignment. And those who will do his job properly can get 100 credits to his portfolio. So your participation is welcome. And please be ready, just not only to listen to, but to get something useful for you and provide your ideas to us. So now we are paving to ESG portfolio construction. And Elena, please, I'm providing you the floor.
Okay. Hi, guys. It's really a pleasure to meet you here. And my name is Elena Dimova. So I'm an academic and also a financial market practitioner. So I teach in Higher School of Economics and Finance disciplines. And also in parallel, I'm a strategic director in a private business. So on our master's program, we always try to really give the flavor of the current agenda of the issues that really shake the market and that investors are really looking into. So today we are going to talk about the ESG agenda and how we can use this new source of the analytics for constructing the investment portfolios. The agenda will be as following. Let me first of all to share my screen with you and very quickly run the presentation. So, and I will very shortly will discuss so what to expect and how we are going to proceed. So we are a bit limited with the time, that I guess it's a good thing, because this stimulates us to keep to be on track, to be very focused and precise. And the key idea for today is following. So we are discussing one part of the ESG global agenda, which is focused on application of the ESG factors in the decision-making for the investment process. So within this half an hour, I would like to give you the flavor of some importance of the topic and some practical steps that investors may make in order to make better decisions. And in the second part of the session, I would like to run an Excel template for you, which again gives you a flavor of how the composition of the portfolio can be adjusted to ESG targets. And yeah, so that's sort of the practical exercise. After the session, Rita will kindly share with you all the materials including the Excel templates. So saying that, I start with my 15 minutes theoretical parts that covers the ESG agenda. So first of all, I will give a very quick introduction to ESG investing, highlighting the importance. Then I will I will jump into some practical aspects of the building an ESG portfolio and which data is available. Then we practice a bit with the constructing of the portfolio for assets and using the functionality in Excel, which is known as Solver. And I still hope that there will be some time. If not, you will be able to go through these slides on your own. There is more pieces of information related to available screening tools for finding the ESG factors in some open resources, and also the importance of the ratings and how they can be used for making investment decisions. So let's start. The first question is, what is ESG investing and why is it on rise? A bit later, I will remind you what ESG stands for. If there are some students who have never heard about this, I guess there are not so many people, but the disclaimer, not the disclaimer, but a bit being ahead of my presentation, we may mention that ESG analysis equips the financial analyst that with a new and very valuable piece of information, which is a bit of the different from the financial informations that we can get from the balance sheet, income statements, and other financial documents. And why it is good for investors? Because it helps to assess, to make an assessment of the new types of risks that is quite difficult to reveal with the standard financial analysis, but still these issues may have a very tangible and very strong negative effect on the performance of the business because of the loss of money and basically the value of the company that has an impact on the stock price. So to sum up, we may say that ESG investing, it's a certain approach to investing that may be considered as a complementary type of the analysis, where we pay a very strong attention to environmental, social, and corporate governance issues with regard to the performance of the company, with regard to the long-term investment projects, and revealing the ESG-related risks. As a reminder, I would like to show you a very quick composition of and examples of what exactly the financial analyst may look into, or rating agencies which assemble information and assign the ESG scores and ratings for the companies, what they are looking into. Probably I would like to draw your attention to the issues that are social and corporate governance, because environmental issues, I guess it's more or less straightforward that the company, if the company has a negative or positive effect on the environment, it's basically nothing to comment about. However, within the social issues group, there are such factors as data security and privacy. We see that this risk is really rising because many companies today consider digitalization as one part of their strategic focus, but digitalization leads to the less security for many companies because of the inability to manage such risks as IT, hacker attacks properly. Another very important topic, of course, everything related to the customer satisfaction and overall the treatment of the customers, employees, and societies. So we see a number of the strikes today, especially in the in some countries. They are on TV, that I don't know, some groups of people starting with in the airline industry, in the civil infrastructure industry, they are really believe like being treated not fairly because of the different issues. And of course, the corporate governance, this is about the ethical and proper decisions on the higher level in the company. So, and if we see that governors, I mean the company, the board of directors, the executive officers, they are not quite okay with making nice decisions, this also may result in the huge losses for the companies. So therefore, we see that all this considerations, they are quite appealing for investors, and they really see value in incorporating this ESG analysis while choosing the different types of the investors. With this slide, I would like to show you how rapidly the different forms of investments which based on ESG strategies, how extensively, how quickly they grow. And why this matters for us, because in investment industry, if you are going to work in investment banking or equity research field or portfolio management probably field, so definitely you will be dealing with the ESG related strategies because of the high demand and really good value that we can offer to our clients being stick to this agenda. Also, here I would like to start talking about one of the important topic. I don't know where the heading of this slide is. Okay, here we are. This is basically the concept of the materiality. So what does it mean, materiality? Materiality means that factor that really have a very important impact on the performance of the business. So here I would like to draw your attention to the existence of the so-called sustainability accounting standards that highlight the most important materiality factors for the different industries. So what does it mean? For instance, we may see that there may be some industries that probably are some ESG factors for them, they are more important than others. For instance, if we like stick to very traditional standard business, probably it is construction business or something related in, I don't know, extraction of resources. So probably we may not consider that for such companies, the leakage of data or private security may be really a huge risk. On the other hand, there are producers such as Coca-Cola or PepsiCo, which consumes a lot of water, or textile industry, which also is known for some of the sort of the discrimination of not quite proper labor practices. So, and for these industries, such ESG concerns will be really material. So to sum up, we may say that for investor, the first step is really to understand if we already have made a choice with regard to the industries that we want to invest. The next step is really to have a look at the sustainability standards and understand which particular factors they are highlighted for you to be explored even further to assess the risks properly. Also, on the right-hand side, you can see some warning statistics that relates to the cybercrime and hacker attacks. And we can see that really millions and billions of dollars today are lost because of such concerns and because the companies are not focusing maybe properly and not doing all that they should do. However, for investors, this means definitely the huge losses for the business and decrease in the price for the company, which they would like to avoid. To add to the previous example, I would like to share with you a couple of other examples. I guess the case that on the left-hand side definitely is known for you. It's so-called Volkswagen Gate scandal. So when the Volkswagen company in 2015 was caught for being cheating with the emission tests, and which resulted in the improper quality of the cars that were distributed across the world in the US and some other countries and regions. And here we may see that because of this revealing of such negative practices, it was approximately 11 million cars worldwide that should be revoked from the markets. And of course, the company faced really huge loss analysis because of the fines that were imposed on the business. Another scandal is Toshiba. It's about accounting scandals and manipulating some financials for the relatively extensive time period, approximately 7 years. And also there were some issues related to the board of directors and how the board of directors makes decision probably not 100% aligned with the interests of the key stakeholders. Again, all these examples illustrate that huge impact and very tangible impact on the business can be made if such risks occurs. And of course, through the financial statements, it's very difficult to identify such types of the risks, and the new type of the analysis is really required. Here we have an extract, a chart from the Bloomberg terminal, which illustrates and compares the performance of the two indices provided by the MSCI. And here we can see that the yellow line is the ESG leaders index, which means this index is assembled of the companies which are perceived to be leaders in their ratings in their industry. And the second one is a bit broader index where other companies, not 100% with good ESG ratings, are included. And over the time, as graph shows us, the performance of the ESG leaders is far outstanding, which is really proves to some extent the positive impact on the selecting companies based on the ESG. Our program is relies heavily on the standards of the global investment communities, and basically also to a greater extent to their curricula and the requirements of the CFA Institute, which today also does really a nice job in promoting the ESG standards to the investing for their global investing communities. For instance, they produce a quite nice reports and recommendations how different asset managers can incorporate this investing standards into their day-to-day activity. So we also encourage our students to proceed with their career and to pass the CFA exam. So we help them in doing that. And being CFA ESG standards now today is one of the part of the preparation curricular for the CFA exam. Okay, so now let's move closer to the investment portfolio, and we need to start with the different approaches. How can we treat ESG information with regard to companies? Typically here we could identify two huge, I would say, strategies / approaches. The first approach is so-called value-based investing. That's the approach when the investors try to pick up the companies considering their very good performance on the ESG factors. So here we are not very much concerned with very, specific factors. Some examples I will provide a bit later, but we understand that high ESG scores and high ESG ratings definitely confirms that the company has less ESG risks. So this means that performance will be better, will be more stable, and probably the company has a competitive advantage over the other companies which has a much lower ESG ratings. So value-based investing is just selecting the companies based on the high ESG ratings because we believe that their financial performance in the long-term period will be much more sound and impressive. The second approach is so-called values-based investing. So here the focus is the individuals and or the community of individuals / investors. So what does it mean? Today we know that especially young generation, millennials and other younger people, they really care about the different types of the problems and issues around the world, about healthy lifestyle, about protecting the environment, and I don't know, providing equal opportunities to many employees and so on. And such investors, when talking to their investment advisor, they should, before setting up the investment policy statement, they may highlight which companies they want to avoid because of their ethical beliefs. For instance, here you can see the example of some companies that may generate high revenue. However, from the ethical perspectives, they may not be very desirable for some groups of the investments. So values-based investing today is also booming because the investors have a chance to incorporate their beliefs. They integrate their ideas and values into their investment making decisions. So typically they try to avoid so-called 7 sins company. So the companies with 7 грехов. I would like to comment on Russian as well. As for the ESG investment styles, this may be different approaches: negative screening, positive, relative, best-in-class screening, full integration, and many other. The most popular are negative screening and positive. What is the difference? The difference is that when we use the different filters probably available in our open resources, there are many websites that provide such functionality, and professional terminals also provide this functionality. We just filter out the companies with the ESG ratings below a certain desirable level. So we say, okay, no, that's too low. We don't want this company in our portfolio. The positive screening is a bit opposite approach, when we prefer to concentrate on the best companies with the higher ratings, and sometimes it may look like best in class, where we also consider not just ratings across all the companies that we want to consider, but we focus on certain ESG benchmarks in the different industries, because definitely the ESG ratings, they vary across the industries, and this should also taken into consideration. Also, a very interesting strategy, portfolio strategy, is so-called portfolio tilt. So tilt means that especially it is okay for the passively managed portfolios. So what does it mean, passively managed portfolios? They are so-called known buy and hold long-term portfolios. So when we want to assemble portfolio and keep it for a relatively long period with a very rare rebalancing. The portfolio tilt strategy help us to increase and improve the proportion of the assets that we dedicate to the good companies. And here there may be again a mix of the consideration. The good companies may be just with high ESG ratings, or the good companies may be with the relatively modest ESG ratings, but because they belong or behave in a certain way, they are not tobacco, they are not engaged on polluting, or they are not doing some other things that investor really cares about. Now let's move to the core part, how to build an ESG portfolio, what are the key steps. And after that, I guess in 5 minutes, we are going to look a bit into the Excel template calculations. How can we adjust the ESG weights, ESG rate, how can we adjust the proportions and weights of our assets in the portfolio, considering the ESG scores. I would like to remind you that traditionally constructing the portfolio looks like that. So we heavily rely on the principle of the diversification, which means, as a reminder, that we base it on the correlation between different assets. This is again mathematical approach. We identify companies which returns they move in a bit different directions. So typically it's a contra-cycle, cyclical and cyclical companies. So like sun is shining or it is raining. Or the performance of which companies, so they better in which conditions. So diversification, finding such companies is one of the key principles. Another key principle is for investing. Investing is more about long-term strategy. So we consider a relatively long-term investment horizon, because portfolio, it's basically not about the speculating. So typically when we talk about the portfolio, it's a more prolonged long-term investments. For the ESG, we add in one more step. So we adjust, or even on the selection process, on the screening process, we start selecting the companies and taking into consideration their ESG scores and some other priorities. So here we need to mention that there is no such one-size-fits-all approach for the portfolio, because when you construct your conservative or typical portfolio based on the traditional portfolio investment principles, this portfolio should meet the objectives and characteristics, requirements of the particular investor that may really differ across the different types of the investments. And ESG portfolio follows the same logic. So ESG factors that may be incorporated in these portfolios may be absolutely different. The most general step are the following. We need to set up, as for investors, the ESG priorities, what do we really want and what we care about. For instance, for huge institutional investors, there may be a policy of their key investors, I mean for the investment funds, which really want to stick to a certain ESG strategy. For instance, they want to support some sustainable energy industries, for instance. So this would be their priority. Maybe some other ESG issues may not be of a greater concern for them. Then we need to choose the approach. So what does it mean? It means that there may be, again, some mix of the choices, how we select the companies. Also, if our portfolio is so-called tracking portfolio, which means the relatively passive portfolio which mimics and replicates the index, we may decide what should be the tilt. So the tilt again means how far from the composition of the index we want to change and deviate the composition of our portfolio with ESG priorities, and what would be the trade-off. So what does it mean, trade-off? That trade-off means that we discussed, it's good probably to invest in the companies with a high ESG. However, some positive ESG effect may be achieved on a relatively long time periods. So therefore, or if the person or investor really cares and wants to incorporate his or her values, sometimes it may be done at the expense of the decrease of the returns of this portfolio. Then we build a portfolio, optimize, adjust, and monitor. Let me give you one example how one approach can be used for adjusting the composition of the portfolio based on so-called weighted average carbon intensity by revenue score or approach. What is the key idea behind this approach? So some investors, they may be really pushed to decrease so-called the carbon intensity of their portfolio, of their investment portfolio. What does it mean? It means that many companies, they are engaged in activity. I mean, business activity. So for instance, there is some logistics, they may, when producing, consume energy, and there are some carbon emissions. And for some institutional investments, this may be a problem. So they are encouraged not to finance the companies with a heavily companies that are very intense in producing these carbon emissions, really decrease their proportion in the portfolio. So therefore, for instance, it typically looks like that. First of all, the carbon intensity, or basically the overall emissions for the millions of the revenue is calculated. Then which position or what weight of the company we have in our portfolio. And finally, we may calculate the average ratio for the portfolio. So for instance, this average ratio may serve as the limit or some benchmark below which the portfolio manager can't increase the proportion of investments in this very company, which probably ultimately results in a higher ratio. For instance, here, let me give you a very quick example. We have an energy company, Energy 123, technology and materials. And all this company has a certain type of the emissions, and they earned a certain revenue over the year. So the carbon intensity score is 220 and 67. And here we have the portfolio weights in our, what is the proportion of each company in our total portfolio. And we can see that the overall portfolio score based on this weighted average carbon intensity is 124. Probably at some point of time, the portfolio managers may be forced to decrease the portfolio intensity. This will be a requirement of the key investors which contributed their money to this fund. And they should either to change the composition of the portfolio to decrease the proportion of the company with the high carbon intensity score, or there is one more interesting approach. If the investment is really huge, they may collaborate with the company authorities, with the board of directors, and try to set up a certain plan or approve the program, how the company within the next 2 or 3 years will decrease the carbon intensity in order this huge portfolio investment still will be able to keep the stocks of this company in their investment portfolios. So now I guess it's high time to jump into some practical visualization and maybe provide some illustration how the correction of the weights can be done. And before we did it, one more piece of information. So for instance, there is so-called a true cost environmental data set, which is provided by the S&P Global Marketplace. I just would like to give you one just a flavor that today many type of the data is really available, and analysts may find emissions, may find different scores provided by the different types of the ratings agencies and the special institutions that collect such data, and it could be used for making portfolio decisions. So portfolio of 4 assets: ESG, optimization, and solver. So let me find, where do I have this? Okay, yes, this one. Okay, so first of all, let me give you a quick flavor of what do we have on the screen and what type of information we are going to work with, and what would be our step-by-step calculations. First of all, what we are going to do, we are going to find the optimal weights in the portfolio, which is constructed of the 4 stocks. The detailed set of data for such stocks, which is GE, Kellogg, Johnson & Johnson, and Microsoft, is provided in the supporting tabs here. I've downloaded them from Yahoo Finance. So, we have, I have calculated the variance covariance metrics that should be used in order to calculate the portfolio standard deviation. Then I also, based on the information provided and downloaded that I've just showed you, the average returns. The returns are provided on the monthly basis. I also need for my calculation the risk-free rate, which is basically yield on the government bonds of the US. And also we need to specify the weights of the companies in the portfolio, and then solve or use the solver functionality, which help us to figure out what should be the combination of the stocks in the portfolio, which would maintain the certain ESG score within our portfolio that we meet our benchmark. For instance, there may be the requirements that we need to compile a portfolio with the ESG score not more than 25, for instance. I would like also to mention that today there are some really broad range of the information available on about the ESG ratings, but the confusing thing is that it sometimes really not contradicts, but they may provide you a bit misleading results when compared. And also, they have a different methodologies, how the ESG risks are treated. The most available source is the Sustainalytics data. For instance, the Sustainalytics ESG scores you can find in the Yahoo Finance. For instance, if you go to the Yahoo Finance, you type the ticker of the company you are really interested in, and you need to be navigated to so-called screeners, where you could, you even don't need to type the number of the company. So here is how, with the help of the screeners, we could set up a number of the filters and, for instance, set up the requirements that we want to have only those stocks with the companies with the ESG ratings is less than 22. So what does it mean? It means that we set up the filter which provided us the universe of stocks to choose from with a very good ESG ratings. Here I would like also to tell you that sometimes the more is not the better. For instance, the Sustainalytics ratings have a bit of the inverted logic. For instance, the low scores, they mean that the ESG risks are not very high. So in this case, we can see that the lower the ESG ratings provided from the Sustainalytics resource, the better. So not closer to 100, but vice versa, closer to, no, 0 is probably impossible, but really something around maybe 10, 20, something like that. Okay, so there are a number of the steps that we need to perform. First of all, we need to put some random weights of, for instance, our perception about what should be the weights of such stocks in our portfolio. I would make them really random, but I believe probably that GE is a powerful company, diversified with a huge history and quite powerful revenue generating businesses, so probably let it be 0.4. The Microsoft is also quite nice, so, because it's an IT business, it's a quite established business, so probably let's be something like 0.3. And the last two, let's give them 0.5% in our portfolio. So here we have a check that in total the weights in the portfolio should in sum we should have 100 or 1. The next step, we are going to calculate portfolio returns, portfolio variance and standard deviation, and also we will calculate the Sharpe ratio, which is very frequently used as a measure, as the comparison ratio, if we compare different types of the portfolio. So basically, the higher the Sharpe ratio, the better. And also we will calculate ESG score. And finally, we will, with the solver, we will try to adjust the weights of our portfolio that give us the ESG score that is quite or relatively low and meets our requirements. So first of all, how we calculate portfolio returns. The portfolio returns are calculated as a weighted average of the returns. So here we may use the function mmult. So let's put it this way. Month, and we need to take the average returns first and then the weights. So the portfolio returns monthly is approximately 1%. Let's make a reality check. Microsoft demonstrates higher performance, approximately around 2. Here is about 1, and this is lower. But yes, more or less, we can see that yes, 1% is a quite rational approximation. Formula does not give us the correct result. The second thing, we calculate the portfolio variance. The formula for calculating portfolio variance is quite complicated, and we make a bit of the way around. We will use a covariance matrix, and we will use the combination of the two Excel functions, which is mmult and transpose. So the steps looks like that. We combine them with the information about the weights and basically the the variance covariance matrix. So you can practice this by yourself. So I will also share the template with you. Here you can see the instructions. So you can replicate this when you will revise in our agenda for today and what we covered. Okay, so transpose, the first a set of data that we need to select is the weights. Then we need to select the variance covariance matrix, and then weights again. So here we have 2 brackets and Shift Control Enter to get the portfolio variance. However, the portfolio variance is not the typical measure of the portfolio risk. So the more comfortable is the standard deviation. So the standard deviation is the square root of the variance. So we use a function square root, and we get approximately 5% is the risk of the portfolio, and 1% is the returns. It is difficult to say, is it a good or bad portfolio? We need to calculate Sharpe ratio. The Sharpe ratio, you can Google for the formula, but definitely it's relatively easier. So these are so-called excess returns. So that's basically the difference between the portfolio returns, expected portfolio returns, and the risk-free rate. And the risk-free rate. So this is an extra premium that we are going to have in relation to the 1 unit of risk. So the key idea here is the higher, the better, because the higher ratio means that we get higher compensation in terms of returns per 1 unit of risk. And finally, we also need to calculate the portfolio ESG score. So here we use the function sum of the products, which means sum of the product, which allows us to calculate again the weighted average among the ESG scores, ESG risk ratings, and for the portfolio. Yeah, so we see that the portfolio ESG score is a 28. No, okay, let it be 29, and the portfolio and the Sharpe ratio is 0.14. Now we are arriving to the final task for today. So we are going to make an optimization. So let's consider that we have a requirements that the ESG score should be less than 18. Why less than 18? Because we discussed that the lower the better. And for instance, less than 18, these are requirements for our group of the portfolio investors. So, because still this business is good from the perspective of the generating revenue, we make one more adjustments that the minimum weight of each stock should be not less than 5%. Let's use Solver to perform such task. We need to go to the Data tab and use the Solver functionality. Sometimes this Solver is not by default activated on your Excel functionality. You need to go to the parameters and find how to activate, or just Google for it. There are instructions. What is our objective? Our objective is to select the ESG score for the portfolio. We click on this cell, and we need to set, our objectives will be basically two. The first objective is to maximize Sharpe ratio, because the higher the better. We can change the cells. We need to select the weights, and we need to develop a number of the constraints. The first constraint is related to ESG score. So for instance, here we specify that ESG score should be lower or equal, let it be 18. Okay. Then we need also to add some constraints because this cell should be equal to 1, because the composition of the portfolio should contribute 100%. Okay. And the proportion of each weight of each stock should be not less. So I select these stocks should be more or equal 5%. So I guess like that, because we still don't want all the stocks are excluded as our portfolio. We want them still. Okay, so let's see, what do we have? Okay, we have the ESG score for our portfolio adjusted according to the requirements of the group of our portfolio investors. We also observe the increase in the Sharpe ratio, which increased from, I guess, 0.14 to 0.28, which is double increase. That is good. And that's it. So for instance, again, what we did, we constructed an optimal portfolio, which gives us a relatively nice Sharpe ratio in comparison with some other options. We need to focus more on investing in Microsoft and Johnson & Johnson. Microsoft to a great extent. However, still some minimum proportions of assets of the capital can be allocated to General Electrics and Kellogg. And we also make sure that the requirements for the minimum ESG risk ratings for the portfolio is also met. So that's basically that's it from my side. I guess apologies for maybe being delivering a bit longer than expected, but really the topic is very interesting, very challenging. And if you develop the skills of integrating ESG factors into the portfolio construction. And there is one more area is integrating ESG factors in the valuation of the companies. So that's another set of the practical skills that you may develop. And I think I am done. So hope you will be interested and develop your skills as financial analyst to have a really high salaries and be in demand in our financial industry. So thank you for following me.
Elena, thank you very much for this very interesting presentation. So guys, you can see that it takes, some time to understand it. It takes, some hard work how to do it, but nevertheless, it's finally all very easy to do. So please do you have any questions? Please don't hesitate to ask. You can, type in the chat, or you can just show up.
As Rita mentioned, that after our presentation, she will forward all the materials, so you could practice and do the same as I did. And also you will be provided a number of the ESG related questions for your essay that will help you to get some not interesting, but extra points for your portfolio. So yes, answering these questions may require you to familiarize yourself with some interesting ESG reports that are available, and you may it may be handy. Let me put it, PRI. This is a source for ESG investing related information, and you may use this source to answer the essay questions. So that's a hint from me. Yeah, that's a hint from me how to succeed with your essays.
Good hit, thank you. Guys, questions? Once more, don't.
Hello. My name is Dasha. So thank you very much for this lecture. And I have actually one question related to the valuation. How particularly could we use these ESG factors to evaluate the company?
Okay, so the ESG, using ESG factors for the purpose of the building financial model can be done in a couple of ways. The two major approaches is either to adjust the cash flows directly. So for instance, building this DCF model, we are forecasting future cash flows. And for instance, there may be some considerations that because of the tightening regulation with regard to the ESG, maybe carbon emissions or some other factors that regulators are really concerned about, this may mean that the company needs to invest more, for instance, in CapEx, which is ESG related projects. So for instance, you can increase the amount of the CapEx that would potentially company will need to have in order to meet this ESG agenda. Also, there may be some integration on the level of the scenario analysis. So for instance, one of the final step of the of the DCF valuation is to run the sensitivity or scenario analysis. And for instance, you may consider different scenarios, positive, negative. Let me give you one example. If we have maybe a company with from the country which is in textile industry, and there are many cases of maybe water pollution or some really not quite nice factors that may result in the fines for this company. So for this negative scenario, if such cases occur, you may also make adjustments for the losses that a company may potentially have. And the final also thing is when we adjust discount rate in our evaluation model. So there probably we can make the adjustments to beta when calculating cost of equity. So using capitalist pricing model, but here we need to be very cautious in order to avoid double counting and not to increase the perceived risk to the degree that is greater than should be. No, okay, so a bit later, I am quite happy to share or deliver the lectures on valuation and how the ESG can be integrated. So I have examples, templates to share. Yes, so this is something to expect.
Okay, guys, other questions, please? Dasha, thank you very much.
Okay, still it was just a quick introduction to the topic, and I would like to highlight that it's not just how to say it, blah blah blah, right? It's important because of the important, but on the basis of the ESG agenda, you as financial analyst will really require to develop some skills that today is it's quite a short availability. So, and if you will be able to really keep an eye on your techniques and approaches, you will be quite in demand and stay out of the pack among other applicants to the interesting jobs and positions.
Okay, guys, if we don't have any other questions, just I remind you that you still have an opportunity to submit as an essay and to increase the number of credits in your portfolio. We will be eager to get it.
Mhm. Okay, so Vasily, can we thank our guests, and maybe now I can
Thank you very much that you spent with us, this wonderful evening, because tomorrow it will be raining.
Oh,
so instead of doing something unuseful, you attended very useful event. Thank you. Okay, and take care.
okay, thank you very much, and looking forward to having you in class.
Yeah, sure.
There's much thing to do.
Thanks. Bye, guys.
Bye.